Welcome, YouTube, to The Financial Twins. I'm Mark. And I'm James. And today we're going to be talking about our favorite investment, real estate. We are going to break down all the pros there are with houses to show you how you could get one with very little down and explain what makes real estate such a powerful investment. I strongly believe real estate is the fastest way to grow wealth with the least amount of risk. While you will be doing more active work than something like stocks that you just put away and wait, houses require at least some work, but probably not as much as you think. Let's talk about a couple of reasons why I love houses. And at the end, I'll share with you the first house I ever bought, what I did, and how you could get a house of your own. We will cover managing the houses and other cons in other videos. For now, here are the top 6 reasons why we love real estate. 1. Leverage. To buy a house, you don't need 100% cash to get the property. Oftentimes, with investment properties, you can put 20 to 25% down with a mortgage loan. If it is your first home and you are owner-occupying it, it's possible to get as low as 0% down. If you put 20% down, this would mean if you bought a $100,000 house, you would only need $20,000 to purchase the property. The cool thing is, with that $20,000, you've just now acquired a $100,000 asset. If the house raises by 5% that year, it would grow from $100,000 to $105,000. Now, 5% growth might not sound that great compared to stocks that do 10 to 13%, but let's take a look at how much return on investment you can get with these houses. For example, if we put a $20,000 down payment and after a year had $5,000 worth of equity built into the home, that alone is 25% return on investment. This happens because we are leveraged in this house to a 1-to-5 ratio. This means that we only put in 1/5 of the property's worth. Whenever the house goes up by 5%, our ROI is 5 times greater than that 5%. This means in this situation, we got 25% return on investment. This gets really exciting when talking about massively larger growth in a year and putting even less down, making the ROI a lot higher. As much as this is a positive thing, the negative effects are equally as powerful. If you are leveraged a 1-to-5 ratio and the house decreases 5%, that would mean a negative 25% return on investment. The good thing is, generally houses go up. You might have a couple bad years, but given enough time, it should stabilize and make you profits. Our second favorite thing about real estate is cash flow. Cash flow in a property is your profits from rent after accounting for all monthly expenses. It's pretty easy to calculate. Just make a list of your expenses, do some research on what those expenses will be, and subtract them with your rental/property income stream. I say property income streams because there are a lot of ways to make some extra cash on a house besides just rent. To list a few, you could rent out the garage, have a coin-operated washer and dryer, Airbnb a space, as well as many others. To get this cash flow, we look at all the expenses. These normally are property tax, vacancies, repairs, mortgage, insurance, property manager, utilities, and taxes. Although utilities can often be paid by the tenant. If you're doing everything right and talking to a tax professional, you should see very little or no taxes on the income from your properties. Using real numbers from my own house, let's see what my cash flow is. I have a house that is worth $280,000. It's a duplex. One side can be rented out for $1,500 a month and the other $1,000 a month, for a total of bringing in $2,500 a month. Some of these expenses are not going to be taken out every month and are a sinking fund, such as vacancies. I know eventually I will have a vacancy. I can save 5% of the monthly rent for future vacancies. The expenses are property tax, $466, vacancies, $125, repairs, $350, mortgage, $966, insurance, $101. The total expenses are $2,008. With an income of $2,500 a month and expenses of $2,008, that leaves a cash flow of $492 a month. Now we know that I have a positive cash flow in property, which is good. But exactly how good is it? If he bought this house with 25% down, that would have cost him $70,000 in a down payment. With a cash flow of $492 a month, in an entire year, that's $5,904 of profit. If we divided $5,904 by $70,000, we learned that this is an 8.43 return of investment. That's not bad, especially when you could have a house appreciating at the same time. But there are 4 more reasons why we love houses. This profit after all expenses is also known as cash on cash return. Generally, I try to aim for a 10% cash on cash return. Mortgage paydown. While you're renting out your investment property, if you're not paying all cash, you will have a mortgage on it. Your renter every month will effectively be paying for your entire mortgage. Some of your mortgage payment will go into principal and some will go into the interest. Principal in a loan is the actual amount due, such as with this example, there's $210,000 left in the loan, because the down payment was $70,000 for a $280,000 house. When the mortgage gets paid, it pays off some of that $210,000 plus some interest is added to it. Without going into super detail on a bunch of different numbers and amortization schedules, the principal in my mortgage is roughly $300 every month. That means that after a year, I would have paid off $3,600 in my loan, bringing my loan down to $206,400. This may not sound like a lot of money, but this really adds up after many years. If it was a 30-year loan, the whole house would be paid off in 30 years without me paying anything in, and my renter paying for all of it. Taxes. There are a ton of tax advantages for real estate investors. I am not a CPA and I can't go through the list of benefits, but just know that the government is very generous to real estate investors because we provide houses. If it wasn't for investors buying homes, old homes wouldn't be flipped, apartment houses wouldn't be made. This would halt a lot of housing production. Only people who can build their own houses from the ground up could really make houses, and that's really expensive. This would cause terrible situations for everyone. The demand for houses would go through the roof, while supply wouldn't be able to keep up, causing a housing crisis where there just isn't enough homes. This is one of the few reasons the government gives tax breaks to homeowners. For taking the risk of getting property and renting it out to people, homeowners get a lot of tax breaks. Speak to a tax professional to learn about the specifics. If you're doing everything right, you'll be able to write off pretty much all of your income taxes from the property. Although you will be paying for property taxes, the offset in the income tax is a nice benefit. 5. Fixed monthly mortgage. Because you can get a fixed mortgage for 30 years, the payment won't go up throughout the entire duration of the loan. Unlike rents that just keep going up every single year, my mortgage will always stay the same. The first few years might be more expensive for your mortgage, but after a few years, the rent will just keep on going up. Your mortgage will start being cheaper in comparison. In my market, houses have been going up 12% on average for the past 6 years now. Rents have been a little slower, but still growing at a really fast pace. Rents that were in my town $600 5 years ago are now $1,000. This pattern will likely continue due to the short supply and high demand in the market. Almost all the markets. That means if your rent is $1,000 today and it raises by 10% per year, in as short as 5 years, it could be $1,600 a month, which is a lot more expensive. With a mortgage that is $1,300 a month, yes, it's more expensive than rent right now, but after a few years, the mortgage could be cheaper than the average rents, saving you money. 6. First-time homebuyers and owner-occupied programs. As mentioned earlier, most investment properties are purchased with 20 to 25% down payment. For first-time homebuyers and owner-occupied houses, there are many programs that let you use lower down payments. For example, there is the USDA, which loans allow for 0% down payments for single-family property. There is also the FHA 3.5% down, which allows an owner-occupier to buy a 4 or less unit multifamily property using only 3.5% down. There are usually price limits to whatever loan you might go with, as well as other requirements like credit score, work history, and debt-to-income ratio. Let's pull all this information into a real-world example. This is the breakdown of the first property I ever bought with my wife. I bought my house for $230,000. It is a duplex. One unit is upstairs, 1 bedroom, 1 bath, and it's pretty small. The other unit is downstairs, much larger, 2 bedroom, 1 bath. I used the FHA 3.5% down loan. Purchasing this property cost me $8,000 out of pocket. I live in the bottom, larger unit with my wife and rent out the upstairs unit for $850 a month. My mortgage was $1,250 a month. For comparison, I lived in a duplex just before this. It was a 1 bedroom that was pretty large for $1,000 a month. Most 2-bedroom apartments at this time were around $1,150 to $1,250. So owning my house was almost the same price. With rent from my top unit bringing in $850 a month, I effectively was living there for only $400 a month. And I didn't have to live with the tenant because he was on his own unit. Because the top unit pays for most of my mortgage, that saves me $450 a month. In a year, that's savings of over $10,000. This already would have given me more than 100% return on investment on the money I invested. This alone makes getting a duplex worth it, but it gets way better. I bought my house in the spring of 2020. For any of you who have been watching the housing market, you know that 2020 was an absolutely crazy year for appreciation. My city went up something like 25% in 1 year alone, which is ridiculous, but it makes sense. What this meant for me is that I bought my house for $230,000. It is now more than a year later, and my house was just appraised for $280,000. At $280,000, that means that my house has just increased by $50,000 in 1 year. With only putting $8,000 down, that alone makes it a 625% ROI. This means that in the past year of this one property alone, I had $50,000 in appreciation, $10,000 in rent savings, and $3,600 in the mortgage paydown, for a total of $63,600 in profit in 1 year. The down deposit was only $8,000 out of pocket. That's nearly an 800% return on investment. In my area, because prices for houses went up so high, if I tried to rent out my bottom unit, I could easily get $1,500 a month for it. If I move out and buy another home, even after all expenses, I would have a positive cash flow close to $500 a month or $6,000 a year. And for something that I bought for $8,000 last year, that's a really good ROI. I understand that last year was not a normal year for appreciation, but what we really want to make clear is it wouldn't have mattered last year if my house didn't appreciate at all. I try not to count on appreciation because you never know what's going to happen. But even without the appreciation, there's still positive cash flow, there's still the mortgage pay down, and there's still tax write-offs. Once I move out, it will be giving me an ROI north of 12% not counting appreciation. Anyone can do this. With the right tools and education, you can own a house and start building your wealth. To start your real estate investing, you don't need 20% down. You could get a fourplex with as little as 3.5% down. You could live in one unit and rent out the other three, effectively living there for free while the house appreciates, and the renters will pay you the mortgage. We hope you learned something from this video. If you have any questions, please leave a comment below or email us at TheFinancialTwins@gmail.com.